What is the policy mix in economic management? Imagine trying to steer a boat through choppy waters. You need to use different tools to keep the boat steady and on course. That's what countries do with their economic policies. They combine what's called the policy mix. This mix involves two main tools: monetary policy and fiscal policy. Monetary policy is managed by the country's central bank. It controls interest rates and how much money is in the economy. When inflation is high, the central bank might raise interest rates. This makes borrowing more expensive, so people and businesses spend less. It helps slow down inflation. On the other hand, if the economy is slow or in a recession, the central bank might lower interest rates. Cheaper loans encourage borrowing, spending, and investment to boost growth. Fiscal policy is controlled by the government. It involves decisions about taxes and public spending. When the government wants to stimulate the economy, it might cut taxes or spend more on infrastructure, healthcare, or education. This puts more money into people's hands and encourages demand. If inflation is rising too fast, the government might increase taxes or cut back on spending to reduce the amount of money circulating. The challenge is balancing these policies to keep inflation in check while supporting growth. When inflation gets too high, countries often tighten both policies. They raise interest rates and cut spending to slow down price increases. During a slowdown, they loosen both policies. They lower interest rates and increase spending to help the economy recover. Coordination between the central bank and government is key, even though they work independently. They enforce shared goals like stable prices, steady growth, and low unemployment. But their tools and timing can sometimes conflict. For example, lowering interest rates might boost growth but also risk higher inflation. So, policymakers need to carefully plan and adjust their strategies based on current economic conditions. A well-managed policy mix helps keep inflation moderate and the economy stable. If inflation is rising, tightening both policies reinforces the effort to bring prices down. If the economy is weak, loosening both policies encourages growth without causing excessive inflation. It's all about finding the right balance to keep the economy healthy and inflation under control.